Geofinance here. One channel, one mission. Geofinance on YouTube. That's it. Everything else is a copycat trying to ride this format and sell you something. They don't have the data and they don't have skin in the game. The only thing they can't fake is verified analysis and documented calls. So verify it and watch this video completely. If you can't sit through 10 to 12 minutes, I don't know what to tell you. Every section builds on the last. Skip and you'll miss exactly what you came here for. Now, last video I told you to watch the gap. I told you that Kinesis Silver was trading near $100, Hyperliquid at $96, Pax G Gold at $5,400, all while Western Spot closed Friday at $93 on silver and $5,278 on gold. Physical-backed crypto markets running all weekend, giving you real-time price discovery while COMEX slept. I said those numbers were your preview. I said precious metals are likely to gap higher when markets open. And that's exactly what happened. Silver gapped from $93 to nearly $97. Gold punched above $5,400. The premium told you before the open. But here's where today gets complicated and more important than the gap itself. Silver is now at $90. Gold is at $5,346. And the story of why that reversal happened, what it means for where we go next, and what's happening in China right now is the entire video. Because what played out this morning is a masterclass in understanding regime dynamics. Who leads, who lags, and why the market is behaving in ways that don't make surface-level sense unless you understand what's actually driving it. So let's start with China. Because while American markets were getting ready to open, China was already in a full-scale physical gold buying frenzy. China's largest e-commerce platform adjusted gold prices to the equivalent of $5,574 per ounce this morning. That's already staggering. But then the physical supply started running out. Major physical gold stores across China stopped selling investment gold bars entirely. They're only offering craft gold bars now, decorative pieces at the equivalent of $6,129 per ounce. Let that number sit for a second. $6,320. Western Spot is sitting at $5,346 as I'm recording this. That's roughly a $1,000 premium on physical gold in Chinese retail stores because they ran out of investment bars to sell. This isn't a technical divergence. This is physical scarcity showing up in real time in the world's largest gold-consuming nation. And then the platform itself broke. Jingdong Finance, running gold accumulation products in partnership with Deshang Bank on China's largest e-commerce platform, crashed this morning when markets opened. Severe congestion, unable to log in, unable to purchase. A country with 336 trillion yuan in savings. That's the number. And a significant slice of it tried to move into gold at once. The system couldn't handle it. Every major bank reporting a gold buying rush. Every Chinese gold miner hitting the daily limit up. This isn't quiet accumulation. This is a stampede. And here's the thing that should make Western investors' ears perk up. Chinese miners are limit up. Western miners are not following yet. If you've been watching this space for any length of time, you know that historically, miners tend to amplify the move in the underlying metal, sometimes 3 to 5 times. That divergence between Eastern and Western mining stocks right now is either an opportunity or a warning. The ones who do their homework are going to figure out which one faster than everyone else. Now let's zoom out to what's actually driving this and why it matters beyond just a safe haven trade. Iran has now struck 15 different countries or military installations. That's not a number I'm sensationalizing. Count them: Israel, United States, UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, plus French, Italian, and British military positions. This is not a contained regional conflict anymore. This is a multi-front military engagement hitting the world's most critical energy infrastructure simultaneously. Saudi Arabia's Ras Tanura, the largest oil refinery in the kingdom, processing 550,000 barrels of crude per day, has halted operations after an Iranian drone strike. At the same time, Iranian drones struck Qatar's Ras Laffan energy complex, one of the most critical pieces of liquefied natural gas infrastructure on the planet. Qatar Energy has stopped LNG production. Qatar accounts for roughly 18% to 20% of global liquefied natural gas supply. Gone. And European natural gas prices exploded 47% in a single day, the largest one-day increase since Russia invaded Ukraine in 2022. That's not a glitch. That's a market pricing in genuine supply terror. Meanwhile, Kuwaiti air defenses shot down 3 U.S. F-15E fighter jets. The U.S. has canceled 41% of all scheduled Middle East flights, and Trump said publicly, and I'm not editorializing here, this is direct, we haven't even started. The big one is coming soon. So you have the largest Saudi refinery offline Qatar's LNG offline Hormuz functionally frozen, as I detailed in yesterday's video. 15 countries engaged, the U.S. president signaling escalation. 30% of global oil supply is effectively offline or frozen right now. And yet, oil is going down. Let that sit for a second. 30% of global oil supply disrupted, and the price action is suppressed. Someone is working very hard to hold that number down despite everything that's happening. Oil gapped higher, 8% to 9%, and is now fading. It has drifted down from $73 to $70. Mark Douglas wrote in Trading in the Zone about the distinction between what the market should do based on fundamentals and what it actually does based on positioning and control. This is that lesson in live action. The paper short stack on oil is doing exactly what concentrated short positions always do, buying time while physical reality builds pressure underneath. This connects directly back to something I covered last video, and it's worth saying again clearly. Paper markets and physical reality are separating. We saw it in silver's weekend premiums. We're seeing it in oil's price suppression despite catastrophic supply shocks. Gold is up on the day. Silver got slammed. At the New York Open, silver was pushed below $90 aggressively before trading even started in full. Now, there are two reasons this can happen, and both deserve an honest explanation. The first is macro. This is a supply shock, not a demand boom. A sudden supply shock creates a growth scare. And when growth fears dominate, industrial metals take the hit. Silver carries roughly 50% to 60% of its demand from industrial applications, solar EVs, electronics, AI infrastructure. Defense manufacturing energy disruption of this scale hits those demand projections directly. Gold doesn't have that problem. Gold is purely monetary. No factory needs it. No solar panel requires it. Solar. So in this regime, gold leads and silver lags. That part is textbook. The second reason is less comfortable to talk about, but equally real. A nearly 8% dump from highs, concentrated right before the New York Open. That's macro with a hand on the scale. And here's the other thing. Markets have a habit of doing the exact opposite of what the crowd expects. When silver closed at $94, everyone was screaming moon, maximum bullish sentiment. Remember, I talked about that. When we close at $94, now everyone thinks we're going to all-time highs the next day. And I talked about how sentiment shifts when we rise 5% to 10% and when we drop 5% to 10%. And what happens when sentiment peaks like that? You get exactly what we saw today. A 5% to 10% flush that shakes out every late entry, resets the crowd's conviction, and leaves the ones who didn't understand positioning wondering what went wrong. Sentiment is a weapon when you're the one with size. And when you look at who holds the largest position in SLV right now, the picture gets even clearer. We'll get into that next. Gold doesn't have that problem. Gold is purely monetary. In a growth shock regime, the order is gold first, then silver, then platinum, then copper. The more industrial the metal, the harder it struggles until growth uncertainty fades. And I told you this was a possibility. In the last video, I specifically said gold may lead the next move in precious metals, given the safe haven flow we were seeing. That's not hindsight. That's documented in yesterday's video. But here's what matters now. Pull up the hourly silver chart. Add the 150 exponential moving average. When silver got slammed to $88 at the New York Open, that's exactly where it found support, right on that level. It has since bounced back to $90. That level is critical. If silver loses the 150 EMA on the hourly and fails to reclaim it, if it doesn't hold here, price can go to $84.90 and below. It's a number that will shake out a lot of weak hands who came in expecting a straight line to $100. Shanghai spot silver is sitting at $109 right now. Western spot at $90. That's a $12 premium. Still intact even after the Western slam. Shanghai futures at $105. The premium survived the New York Open attack. That matters. Physical demand in Asia hasn't blinked. The paper price went down in the West, and the premium between East and West actually stayed roughly stable, which tells you something about where the real conviction is. Now let's talk about something that should concern anyone watching silver's price action today. Gold up on the day. Silver dumped nearly 8% from its highs. I already explained the growth shock regime. Industrial exposure, supply scare, gold leads first. That part is textbook and expected. But a 7% dump from highs, that's not just macro. That smells like positioning. Liquidity games. Heavy hands. Know who the largest holder of SLV is right now? Jane Street. $1.3 billion position. I've covered this in detail across multiple recent videos. If you're new here, go back and watch those first. The full breakdown is there. But here's what matters in the context of today. Don't mistake size for direction. This isn't about whether Jane Street is bullish or bearish on silver. It's about control. When institutional quants accumulate a position that size, they are not passive holders sitting and waiting. They are there to extract edge. And their edge comes directly from your reaction. The algos are built for exactly this. Pump hard enough to pull retail in at resistance, dump fast enough to shake them out at support. Rinse and repeat. They profit from chaos. You profit from calm. Those are two completely different games being played on the same chart. What's playing out right now isn't just a military conflict, it's financial warfare. Iran isn't just launching drones. It's systematically targeting economic infrastructure, ports, refineries, LNG terminals, tanker routes. 15 countries struck. The largest Saudi refinery offline, Qatar's LNG gone. European gas up 47% in a single day. Precious metals aren't reacting to headlines. They're reacting to what informed money already understands about what this regime means. Now the resistance case, because intellectual honesty is how you build trust with people who verify things. Silver dropped 8% in under 2 hours this morning. That's not a paper tap. That's a significant technical break that could extend lower if the 150 EMA does not hold on the hourly. Gap fills are real. We gapped up and filled back. If silver loses the 150 EMA on the hourly and fails to reclaim it, we can go lower to 84.90 and below. Western mining stocks not following Chinese miners to the upside could be a warning sign that institutional money is not yet fully committed to the breakout narrative. These are real risks and they deserve honest acknowledgement. But here's what doesn't change regardless of the short-term technical noise. China had a physical gold-buying stampede that crashed its largest e-commerce platform this morning. Physical stores are out of investment bars. 336 trillion yuan in savings is looking for a store of value, and gold is where it's pointing. The Shanghai premium is still 12 on silver, and physical gold in Chinese retail is $1,000 above Western spot. Qatar's LNG and Saudi Arabia's largest refinery are offline simultaneously. The structural silver deficit, 10 consecutive monthly green closes before this week, hasn't changed. And the unresolved question sitting over everything right now, does informed institutional money know something we don't? Oil suppressed despite 30% of supply offline. Silver slammed before New York Open. These things don't happen randomly. Subscribe GeoFinance for real-time updates as this develops. The Middle East situation is moving fast and I'll post data as it comes in between videos. Don't trust me. Trust the data. Invest with logic, not hype. GeoFinance out.